So tonight we're going to talk about a slightly different structure to using a self-managed super fund to buy property. So the most common structure is using a bare trust, where that trust that holds the property sits wholly within inside the super fund and is subject to specific rules that we've gone over in our other webinars. Another structure that can be used is a structure that involves a self-managed super fund on one side and another structure we call the Ungeared Unit Trust on the other. Effectively, the way it works is a super fund technically can't invest in a trust that is owned and operated solely by the members of the fund, except where that trust purchases an asset or identical assets and doesn't use those assets for any gearing at all. Hence, it's called an ungeared unit trust. So this is a structure you would use where you didn't want the debt inside of super, and where you've got, obviously, the resources available with which to achieve the purchase. So Tristan, if we can go to the next slide, please. Okay, so this is a way of bypassing the banks. So most investors assume an SMSF requires a commercial loan to buy property. This is a way of using residential rates to purchase a property and still access funds from your super to reduce your level of gearing. So it's purpose-built legal structure. We get it for each property purchase, but it allows you to use the cash in the super fund to purchase some units in the property or purchase a percentage of the property, and you use a cash out strategy of debt against an investment asset outside the fund. So commercial interest rates can be higher for SMSF purchases, and obviously those higher borrowing costs can eat into the yield, which can put you in a negative position inside the fund. Another risk factor is if property prices go down. So some people are experiencing that at the moment. If you are to buy debt free in the fund, it means you're protecting your superannuation asset from being eroded by interest. So Tristan, if we could go to the next slide, please. So broadly, the way it works is you think about a structure where your super fund has 400,000 of cash available to invest in a property. You either personally or through your family trust or corporation or trading entity have got 400 grand in cash, and you want to use that to purchase a property. Those funds can also come from a cash out from an existing investment you've got outside of super. So we do an equity release loan and use the funds then to contribute into super. Those funds then, assuming they're 400 grand in each pool, can buy, hypothetically, 50% of the units or 50 units in a 100 unit fund each. And so your super fund owns half of the property and you personally or your trust or company owns half the units. So the fund, the unit trust, then ends up with $800,000 in cash, and it just simply goes and pays cash for a property debt free. So as we can see in the worked example, our property cost is 800 grand. A super fund funds half. We personally fund half. Both of those investments are via the Ungeared Unit Trust. We don't require any additional lending. There's no interest cost in the super, and there's no bank approval required. So this is often a means by which, where if we've got to move quickly and people have the available resources, this can often be a way of expediting a purchase because we don't have to go to the banks for a loan. Tristan, if we could have the next slide, please. So, excellent point, powerful but not negotiable. The Ungeared Unit Trust is still subject to most of the rules of superannuation. It's also got some additional rules. You absolutely cannot use the assets of the trust for any borrowing whatsoever. It's often advisable where you're using a cash out strategy against another asset to make sure that you use a broker that has had experience with this investment strategy previously, so that they know they are not to use the asset that's inside the unit trust for any gearing. Normal restrictions apply to residential property purchased through an ungeared unit trust, so you can't use it for personal purposes. So yourself or any relative or associate can't lease it, rent it, use it as a holiday home or things like that. So broadly speaking, you can't use an ungeared unit trust to circumvent the rules of super. However, that said, in an ungeared unit trust, because you don't have issues with lending within the trust, you can purchase properties that are for sale on two contracts, so a house and land package. Often they are dual contracts. You have a contract for the land and a contract for the construction. Inside a super fund and a bear trust, you've got to have a single contract purchase. A unit trust can have two. So that's a powerful advantage that the ungeared unit trust has. You also can't use the trust property for any personal loans. You can't use it for any lending at all, but you can't use it specifically for personal loans, either or related parties. It must be solely there as an investment for the super fund. Breaching these rules breaches the in-house assets test of the super fund, and the ATO can undertake legal enforcement to basically wind up the fund. You've got to sell the asset. It can all get fairly expensive. Tristan, if we can go to the next slide, please. Thank you. So one of the key components of this strategy is giving yourself an additional tool to manage capital gains tax. So I personally make people aware of this strategy when they're in their late 40s, early 50s, and they want to purchase a property as a wealth creation tool for their retirement. So they're wanting to invest in this property and hold it until after age 60. So if they come in and they're, say, in their early 50s, on day one, as we've said, the family trust and the SMSF own half. By year 5, the SMSF owns 65%. By year 10, it owns 80%. And by age 60, the SMSF owns 100%. At that point, even if those people continue to work, we can start a transition to retirement pension on all the members. That entire fund, including the units in the unit trust, are now 100% tax-free. So that property can then be sold and pay no capital gains tax at all. So the property will generate rental income. So your SMSF receives that rental income each year. That is taxed when you're in the accumulation phase. You also have annual contributions going into your fund every year from your super guarantee. And you can also put in personal contributions as well after age 60 if there's still some units in the fund. Basically, it's the flow of that cash over that 10-year period that we're doing a calculation on at the start to basically calculate it out so that at age 60, if we choose to sell the property, we can do so 100% capital gains tax free. That's another very, very powerful component of this strategy. People love it, obviously, because no one likes to pay capital gains tax. And this is a means of making sure no matter how much that capital gain represents, they bear no liability to it whatsoever. Tristan, can we grab the next slide, please? Okay, so the numbers have to stack up first. So like my usual rant with all other webinars for superannuation, we like to do a feasibility on this before we get started. So we just ask if buyers agents want to undertake this strategy, please just send us a couple of pay slips and the last statement from the prospective members of the super fund, and we'll do a feasibility study on what the resources they have available to undertake this strategy. The cost of an ungeared unit trust strategy costs about the same as setting up an SMSF and a bear trust. Ongoing though, there is the additional cost of the tax and financial statements of the unit trust in addition to that of the super fund. You can buy either residential or commercial property in the unit trust. If you buy units in the unit trust using a family trust externally to the super fund, and it wants to sell those units before you reach retirement, it can choose to sell those units to whomever it pleases. So it can sell it, so it can be used as, say, a family investment vehicle whereby the external units are sold to a child or someone else's SMSF that's within the family, and thereby that asset that's held in that unit trust then becomes a longer term family asset that's distributed to family members after the predominant owners turn 60, so there's no capital gains tax. And we've got a number of clients that are doing that at the moment. It's a really powerful tool of intergenerational wealth transfer. So you can contribute more to super to accelerate the buyout. Obviously, most people contribute up to the limit of superannuation guarantee, which is $35,000 this year, and claim a tax deduction for it. At the moment, you can put in an extra $115,000 per annum if you so desire, and you can also bring forward the next 2 years of non-concessional contributions up to $345 if you are in a hurry to, get 100% of that asset held within superannuation. Those circumstances occur, I find, where, say, the unit trust holds a commercial property, one of the members' businesses is leasing it off them. The rents maybe have gone up in that area, so the rent of the unit trust commensurately has to go up, and so they want to get all that income into super so they're not paying too much income tax on it. And so then it becomes just another part of their personal tax management strategy. And that's it. Any questions? Okay, so we've got a question here from Tony. What does the ownership entity look like on the title? Okay, so the title, the property is owned by the unit trust. It's a little simpler than a bare trust. So a unit trust can have individual trustees. We recommend it have a corporate trustee. Makes it a little bit more flexible if people die or they want to transfer it to another generation or whatnot. But certainly it can have individual trustees, but it's the name of the trust. So it would be, Joe and Jill Nominees Proprietary Limited as trustee for the trust, and that's what goes on the title. It's specifically owned by the unit trust, not an asset of the super fund, specifically like with a bare trust. Excellent question, Tony. Any other questions? That's fine. I'll just say this about a unit trust. It is a more complicated structure than the SMSF bare trust. There's a few more rules around it. I prefer them. I think it's a better structure, but it is more complicated. And a lot of people do like the bare trust structure, particularly trustees and members of super, your clients, because the bare trust structure is a lot easier to understand. That said, if you're dealing with people that have got a lot of assets, a unit trust structure can be a really powerful tool for them for both tax management, but longer term for estate planning. So where they're looking to buy assets that are potentially multi-generational, a unit trust can be a really powerful tool for those people, and it's good strategy for them. For an example, I have a client who he and his wife had $5 million in assets in super between them. She unfortunately passed away, so he was then had $2 million worth of assets in the 30% tax bracket for superannuation. Now, fortunately, those assets were all property, and it was all through 3 unit trusts. So what we were able to do, because he was over 60, is we were able to make pension payments to him of $2 million, hence reducing his asset base in the super fund to 3. So none of it was subject to any tax at all. So that was in a tax-free environment. And then the 2 million that went out to him personally, it was in a lower than 30% environment because we could use depreciation and whatnot to offset the income he was earning directly. And so we overall reduced his tax burden, even though he had 5 million in assets in super previously. So as you can see, for those wealthier individuals, it's a really powerful tool that can be deployed.